had moved to a softer tire and could sprint ahead. We also acknowledged the fact that India was kind of taking a pit stop after having gone very fast across time. We were saying that US at that point of time, was basically draining battery. They wanted to go fast, but they were going on, by draining battery. And in India also, within the sectors, it looked like mid cap and small caps were basically taking a break. However, fundamentally, we've been quite okay. We've been actually better than the rest of the world. We are growing. We are probably the fastest. We are the fastest growing economy in the world. And our inflation last time around, when we had the session, it was around 2.1%. And however, the corporate sentiments had cooled down. We discussed about the policy missteps that US did, and the key signal that we've across this entire year that we've kind of thought around is that markets are probably volatile, but we would revolve around a median path. It's not something we don't feel that the market, despite being as volatile as it is, we don't feel that they'll deviate much away from a median path. Nothing dramatic as such. And a larger call that we made was basically have cash, some like a tactical overweight on cash at an elevated level. We at that point of time we showed that while back in September last year we said cash was king. We had kept a lower position in cash, saying that the cash is knight in a way that we're still overweight, but we're not very overweight. We kept a lot of cash in terms of the any possible opportunities which would be available going forward. And in commodities, gold and silver and crude, we thought there would be tactical upside going forward. So across this particular month, we've been reminded again and again that in a fractured world, markets may wobble, but if you are disciplined around asset allocation, if you are disciplined again in the selection of stocks, you can actually turn noise into navigation. So what happened this particular month? If we look at August, again, China was the outperformer among the major economies. Their economy, after taking quite a bit of break post, like just before tariffs as well and post tariffs as well, they were kind of slowing down in terms of the market performance. Even in terms of fundamental, they were slowing down. Last year September, we were thinking of China coming out with a big bang stimulus. What they have tried to do is bring in the stimulus through different policy measures, not give a big bang solution as such. US, the momentum in US, which the way it was going up, has definitely slowed down. While India is still kind of a laggard in terms of the major economies, at least when we look at it from the market performance per se. Over the longer term period, China is the laggard here over a 5-year period since COVID and post COVID. China has disappointed in terms of performance. However, India and US, the benchmark index and the broader index of India have done far much better than what US has done. Now, when we actually look at what's happening globally at this point of time, again, if we look at US, their confidence, at least their business indicators, which basically are those indicators which are leading indicators. These are surveys which is called PMIs, composite PMIs. They have gone up. Their GDP, which was possibly last year, the first quarter of this year, it was negative. Last time that when we spoke, I think it was around 3%. The next estimate of the first quarter 25 numbers have come out to be it was 3%. The estimates have moved up to 3.3%. And the last time that we spoke, inflation was 2.7%. It continues to remain stable at 2.7%. So business confidence is rebounding, but there is a lot of tariff overhang, and we'll discuss it in detail when we go forward. However, some bit of GDP growth is back after the slowdown at the beginning of the year. But inflation, last time as we spoke, it had moved up from 2.4% the previous month, like the month in July, to the month in June. to the month in July 2.7, and then in August the estimates have come out to be 2.7. So the trend has changed after the hikes, the draconian rate hikes in rates. Inflation has cooled down, but now making a low at around 2.4%, they are again trending upwards. Um, in UK, the business confidence is back. These are the leading indicators. The leading indicators say there is some bit of confidence from businesses. However, this does not correlate into the growth and inflation. Uh, Numbers that have come out. Now, in the last meeting, we said that at that stage it looked like it was reflation, but we had cautioned that this reflation could turn into stagflation. Sorry, with the low GDP growth and a very high inflation number. This reflation looks like turning into a stagflation, and there are speculations that they might have to go to IMF for a bailout. So for now, at least UK. The leading indicators, however, being pushed up, they're not being translated into the numbers on the ground. China, on the other hand, fundamentally, they're quite stable. They went through an entire period of deflation, a period with negative inflation. They've come up in terms of the inflation has at least not negative right now. GDP is also kind of constant, and businesses, the businesses, the leading indicators as such also are very stable. This now questions that whether maybe China has it run too fast over the last month as well. So that's something again we'll discuss going forward. Japan, last time that we discussed, and we had this entire section on Japan this time around. We discussed last time around that Japan would stay okay at least for a few months, like few weeks or a month or so. And we had promised that we would bring out Japan on the next meeting. So we have an entire section for Japan, and there things look much better than the rest of the developed world. The business confidence is coming up, GDP growth is going up, and inflation is going down. This is after they had left yield curve control in 2024. They have started increasing rates. That has actually brought inflation a bit down, and there has been wage growth, which is actually giving the GDP the boost up. When we look at Europe, not much different than UK, although your the leading indicators of purchasing managers index, they are kind of going up. However, that's not being translated into the real numbers. At least those lagging indicators of GDP and inflation, they kind of are not showing the same thing. So possibly something to look out for. There also a few countries would, again, speculation is there, would require an IMF bailout. So Europe is something that again does not fare well, at least in the developed markets. At least in the developed markets where a lot of momentum, or what, at least in the terms of fundamentals, where we're seeing is Japan and some bit in US. But again, in US we have a massive tariff overhang. Finally, India looks quite interesting. The business sentiments have, the last time that we discussed, the business sentiments were around 60.7. The business sentiment, the forward business sentiments have like gone up quite a bit. There is obviously an overhang of tariff. There is no more overhang of tariff. Now the tariffs are a reality. We've started that, and they have begun. So there is no overhang as such. We know what our tariffs, what we are being hit with, and we have to move on. There was an entire uncertainty. That uncertainty is out, as we discussed in the last meeting. Now we know what the number is. We even know the repercussion tariffs that have been hit on India, and there is no uncertainty, and that I think displays in the survey. The GDP growth is also going up, and inflation, as we saw in the very first slide, we discussed, it was at 2.1%. It is at 1.6% right now. However, with this inflation number, there is obviously some bit of core inflation stickiness that is that we can actually see here. That is the only problem probably right now. We'll allude to that as well. And inflation could actually drive inflation up, which is not a bad thing. If you're growing at around 7.5, 8%, near to 8%, a bit of inflation back would always drive the economy fast forward much more. There are a few issues, we'll discuss them. Moving on to the next slide. Yeah, so we discussed the GDP growth, the inflation growth, but of US, the high PMI number that has come out. But the question is, okay, can you trust the US data now? Now there is a very interesting thing that has happened last month. Um, the unemployment data in US came out to be drastically bad, and Donald Trump ended up firing the person who comes out with the jobs number, and she was Erica McEntaffer, whom he whom he fired, and then has put somebody else from his own team, somebody called Mr. Anthony, who is now leading the jobs department. Very recently, last week itself, Trump has fired a Fed member called Lisa Cook, and obviously Lisa Cook has moved to the Supreme Court, and there is a big tussle going on right now. And basically, Trump wants somebody of his representation in the Fed as well. The Fed is supposed to be an independent agency. It is supposed to be independent of any political pressure. And this move obviously now gives us a question that whether we can now trust US data or not. All across the time, like across decades, we've fund managers have avoided countries like China, like India, saying that the data that comes out from these countries, we can't trust those data. They are made up, engineered. Um, and US demanded a premium because the data was supposed to be quite good. Um, the question now is that whether US demands that premium or not, because frankly, there's a major shift that has happened. When we talk about valuations, we'll just move to the next slide. And this is how US valuations look right now. So US valuations are at 23 and a half, a little above that times forward earnings. Historically, whenever these earnings have been greater than 21, the future returns over the next 10 years have disappointed the markets. Like it tends to disappointment. They have been negative. The minute you move above 21x, again the flip side could be you would say that the businesses in S&P have changed. They are much more asset light right now. However, given all of that, we feel that the valuations are a little expensive given what we discussed on the last slide, that whether the economy requires a particular premium or not. With these valuations, one should taper down their equity expectations, at least from the United States. And what we believe is that maybe long-term equity returns, some 10-year returns may be muted. Here, we're not saying that you go right now, as today's a holiday in US, tomorrow when the markets open, we don't want you to go and sell everything. We could again, as I said last time around, we could come back to the next meeting and say that now the valuations are at 26. The market may take time to adjust. However, reducing the expectation from US equity is something that one could at this point of do. What we believe is that instead of chasing the US market, wait for the US market to come back to nominal valuations. Any number like below at least 20, you're trying to tilt the odd in your favor rather than chase a market which is actually draining away battery to move very fast. So valuations, we believe, won't tell you when, but they will warn you as to what comes next. And on this particular slide, we'll discuss what the triggers for US equity corrections could be. What we've seen, and this is what we discussed last time around as well, we discussed it in detail that the valuations that AI companies at this point of time, there is the first chart here is basically from Preqin. The number of the share of unicorns, at least till now, is half of those are basically AI based ones. Whenever private equity starts chasing that last bit of leg, that is when valuations kind of become very frothy. The real reason is that who are basically the earners of these particular AI themes. What we've actually seen right now, a lot of money move into infotech. These are these are the spenders of the AI race. Over time, when we actually look at the hype cycle of Gartner, what we realize is that generally the ones who build up at least from the hype That's where a lot of people put in money, but eventually the money is transferred from the spenders to the earners. Who are the earners here? They are basically the energy companies, the infrastructure companies, the data center infrastructure companies, and the materials companies. What we realize is that possibly we've spent, or a lot of money has gone into these spenders, which eventually would transfer back to the earners as such. So again, making a case for a broader equity allocation into US, not just those very info tech companies. If there is money to be put in US again, we still believe that US is at a very premium valuation, and we are not chasing that market. Um, that's there. Moving on to now, what does Fed do? We had this major event again in August. There was this particular event which happens every year, which is called Jackson Hall, which is where the Fed governor, Jerome Powell, for the last 7 years, 8 years, has been speaking every year, and he gives an indication as to what the Fed would probably do over the coming next year and the longer term expectations from the Fed. What we actually on the left hand side, what we see is the 10-year treasury yields of US, and this particular thing tells us that the bond market is waiting for more data as such out there. They're not reacting. They've gone into a very small kind of range, trying to figure out where the next move is. We feel that possibly when the FOMC meets, and this is the title of the today's meeting that we're having here, which is called "Wake Me Up When You Cut Rates." Here, we believe that possibly when FOMC meets in September, at least from the Jackson Hall, some bit of indication that we get is we could see a rate cut. If that happens, it will be a very interesting story. But if that happens, what we realize is that the first knee-jerk reaction that the US yields, the 10-year yield would do is possibly move down. But then sanity will catch up to them. And why would sanity catch up to them? Is that right now growth isn't happening very fast. You had the first quarter right now in negative. You had a rebound at least right now at 3.3%, but your inflation is trending up. And eventually we'll move to the next slide when you'll see that there is a possibility that the consumer demand would slow down, and we would eventually see inflation propping back again. So there will be the first knee-jerk reaction for a rate cut if it happens. Would possibly be downwards, but when sanity picks up, we expect the rates to be higher. At least if when we are having this meeting around 9 months, a year later, we wouldn't want to see rates around at these levels or lower. We would probably want to see it at a higher place, and that is what we discussed in the last meeting as well when we discussed the Genius Act as well. So this is how on the right hand side, this is how the US interest rates stay at this point of time. You had this draconian rise from 2022 after the misstep of basically the inflation is transitory misstep where rate hikes were delayed to bring the economy back, inflation back into control. It's not under control as of, it's still not tamed. The US broad-based range is basically till 2%. Your inflation is at 2.7%, so you still not tamed your inflation at this stage. If you have to cut, why would you want to cut interest rates? Well, because the jobs data was bad last time around. If there is some bit of support that has to go out to the labor market, it has to happen now, or we are looking for a much difficult period going forward. Also, there is some bit of political pressure out there to cut rates as well. So again, Jerome Powell's his tenure ends in mid of 2026. We'll have to figure out as to, especially with what's happening in Fed right now with the firing of Lisa Cook, we'll have to wait and watch. What we feel right now, given our understanding of the meeting at Jackson Hall, we believe that there would be possibly a rate cut. And if that happens, the knee-jerk reaction to the US yields the first knee-jerk reaction should be downwards. But before and after that, when sanity picks up, we believe that the rates could move back higher. And this is the slide that I was talking about, where this is the container ship departures from China to US. If you actually look at the last segment, this is the restocking happened post the tariffs over here, and now you're going back to downwards in a way. The decline in the total shipping in US is also declining. So a lot of restocking happened just post tariffs, and now uh, the trajectory that we would want to watch is these particular lines, whether they completely drop off or they continue to remain at an average, levels as such. So this would mean that a lot of stuff has to be built in US for the US consumer. Are they self-sufficient enough right now? I think not. So there, at least the inflation again, if your supply is limited and the demand stays on, then you would have inflation come back, and that is why I expect the interest rates to be higher as we speak later, possibly mid of next year or early next year when we speak. I expect the interest rates to be higher back again because inflation would possibly rebound from those levels. Having done US, I'll just take a break right now and I'll just open up the floor that if there are any questions, at least on US. Cool. If not, then we can move to India. India has been, although it looks volatile, the feeling is of volatility. But if we actually look at the median return, so what we've done here is basically we've taken data from 2000, the start of this century, to 2025, 25 years of strong data. What we have done is that we've simulated the returns across the year, and then we found the median, what that happens over the year. Now, the red line is the median line that it happens. And what we see is that this year, despite tariffs, despite geopolitical tension, despite war in Iran, despite number of other things that we continue to keep seeing, despite 50% tariffs, we continue to hover around the median. So that's what we started this year with as well. We said this year does not look any different than a median year. This is kind of volatility we expected. It's the only issue with volatility is that your lows are lower and your highs are higher. The last time we met in July, the beginning of July, you were exactly at the median. The last month has been negative. Generally, the median says that the month is positive. So now you're below the median. So any rebound from here, and if you're going to catch up with the median, could lead to some bit of retracement, like some bit of upward rebounds possible out there. The idea is that when the world is volatile, generally you expect a lot of momentum out there. Generally, if there is momentum and if the direction is in one way, the volatility is lower. That's our idea. That's how VIX works. What we believe is that because there has been no clear trend, the volatility is higher, and that's why this year feels very, very, very choppy. And once the year is choppy, you have to possibly rotate around the median. So that's where we started January from. This is from our annual outlook, where we said that we expect the return to be nothing different than a median year, just expect it to be volatile, and that's what we've been doing. This is how we're positioned now, given the correction, given that we had a lot of cash, like cash was nice for us last time around. We've started deploying that cash back, and we've upgraded India to a higher allocation. Here, our large cap, mid cap, and small cap all deserve a kind of an uptick, and overall India goes into a one position higher for us. US, we continue to remain underweight. Europe, we continue to remain underweight. China, we already went to neutral last time around, saying that possibly China could deliver returns. They have. However, given what we discussed last time around, that's not being reflected on the ground data. We're not putting China up there right now, but possibly we'll wait for a little more data to come through and figure out whether they deserve a higher rating or if it does not, we would want to wait for a little more data. Japan is something that we are extremely looking at. There was a lot of discussion to upgrade Japan as well. We think that possibly we'll again wait a little more on that. We don't know the clear sense, and we'll discuss why Japan deserves a little higher. We just don't know where they're going right now, at least in terms of the political direction. Once we are a little more aware about where it's going, we could possibly put Japan up there as well. So we're just focusing on what is doing well. On the ground data, the real hard data is what is driving our allocation. The real hard data points to only one thing, that India is kind of the fastest growing economy in the world, with rebounding, um, you know, good GDP growth, decent inflation, although sticky core inflation, but decent headline inflation, and the industrial production is also coming back. We'll discuss that too. Sectorially, we remain the same. As we discussed, IT remains an underweight for us. We are more we what we are trying to do is here is basically look at a lot of themes which kind of are which push us towards self-reliance. So anything that is infra, energy, metals, where we become more self-reliant in a way, we are kind of overweight those sectors. In banks, we continue to like public banks more than private banks across the year. We continue to do that. Autos, as we discussed the last time around, only those autos which are domestic producing, we continue to like them, and that is why you see a little bit of underweight there, because anything that is being exported at least to the US, that will suffer. And yeah, so it's very stock specific, the auto picks out there. And pharma also, again, at this point of time, there's no exact place that is there. We just kept it to be defensive. If the market starts to show some bit of momentum, given that we have moved up at least on our weightage in India, maybe we'll come back and look at pharma's allocation later this month and figure out where that stands. And that's there. For debt, this one is interesting. The last time around, on our insights, we said that when RBI came up with a 50 basis point rate cut, we said that the bond market did not reflect that. The bond market, instead of yields going down after a massive rate cut, the yields had started going up. That's where we didn't want to go and overweight debt. Right now as well, again, we feel that maybe yields would cool off a bit. There is some bit of debt allocation that a few conservative portfolios deserve, and we continuing with that. However, if inflation does rebound, that strategy is also like that allocation will also warrant a look. Possibly, if inflation starts rebounding up, we expect the yield to go back up again from much lower levels right now. Around 6.6% is where I think 10-year India yields are. Cash, as we discussed, that because we were sitting on a large bit of cash, we reduced our cash positions all across. So this is okay. And why have we gone ahead and increased the allocation in India? Because frankly, the data tells us to do that. The composite PMI is at 65, which is like a fairly large number. Anything above 50 is expansionary. Countries find it hard to stay at 60. We've reached 65. This is quite good. The only laggard that we were feeling last time around and that stopped us from going up was basically the industrial production. The industrial production from a very low base has started to come up back up again, although it's lower than last year, which even is better for us, because then the scope of movement of high is like going much higher is there. We're not fatiguing at a high level. We are coming from a low base. So that's even better in a way. And inflation fairly in control in a way. Although some bit of core stickiness remains. Unemployment rate, as last time around we spoke around, it's lower than last time around, but the trend here is changing, and that is something to keep an eye on. If this employment number starts going up, we don't think at this point of time, the last time around that we spoke and the number that came out was because we were seeing some bit of layoffs in the IT sector. IT sector, anyways, we continue to remain underweight. So overall, it does not affect our positions as such. But unemployment rate is something that needs to be looked at. There is obviously some bit of chatter around unemployment around the textile sector. That is something, again, one needs to look at given the higher tariffs. However, given that our our rivals, at least in the textile sector in Asia, are diplomatically strained. We don't think that unemployment should right now uh, come through and affect these numbers. We'll wait for the July data. I don't think those are out yet. So if yeah, so that's where we are. Um, Business expectation again coming back from a very low base. We are lower than last year, which again supports the whole case that we are rebounding from a very low base. We've taken a break in the middle, a fairly large break. Last September we went on cash. We've taken quite a long break. Almost a year. And that's cooled off valuations in a fair bit, and we believe that that is why India deserves a higher rating. This is how we are positioned today. We've used up all our cashes, like whatever we kept last month. We got fairly bit of cash. We continue to be deployed across equity, debt, gold, silver. Last month, our silver and gold positions were the one that protected, along with the cash, protected our portfolios. Given equity has been kind of sideways across time, that is where we've kind of gotten through. We're still a bit conservative in terms of there is some bit of debt allocation even to aggressive portfolios as well. So that's there. But the major change here is basically the cash allocation. We've gone from somewhere around 20 to 35% cash that we were holding last time around. We've deployed that into India. Given the risk and the reward, the risk we feel right now, again, as we mentioned in the future slides, the risk at this point of time is around 2 to 3%, which we believe, and the upside looks quite attractive. So we okay to happy to take that 2 to 3% risk and move forward. In that regard. Um, yeah, I'll just stop here before we start talking about Japan and just ask if there are any questions that I could answer. Cool. If there are no questions, I'll move to Japan. Japan is an interesting story. Last time around that when we spoke, I thought Japan deserved an entire whole section to itself, and here we are. We're talking about it. So if you have to hear the Japan story, I think we need to go a little bit back. We need to go back into the 1980s. This is when Japan was really flying. Japan after the World War II, their entire nation was destroyed. Industrial productions, etc., was destroyed. They started slowly rebuilding it. US fearing that communalism similar to China may not percolate in Japan. They started helping out Japan in terms of aids and a lot of things. There's a particular system of trade where a family kind of holds a large portion of cash, the wealth distribution channel. They destroyed it, and Japan was able to, with a lot of good policy steps. Japan, being kind of a textile manufacturer, moved up to an industrial manufacturing hub. If Japan made it, the world bought it, was the scene kind of in 1980s. It was a leader in kind of electronic manufacturing across time. What we kind of saw at the end of the decade of 1980s was that out of the top 10 countries in the world, 8 were Japanese. Japan's GDP per capita was basically higher than US, 10% higher than US. The Rockefeller Center, which is the prime building in US, it is very close to it. In New York, it's very close to the Times Square. That was owned by the Japanese. Japan was on a tear. If you actually look at if there is an example of a bull market in equity, if you want to have something like if there is an example to give, it is the Japan market between 1980s to 1990s. The index moved from 7,000 to nearly 40,000. It was like almost a 6x jump in the index itself. An index that comprises of 225 companies that jumped up 7 times. The index was quite high. Wage growth in Japan was super. They did overtaken countries like China, West Germany, others to move up to 5th highest GDP. The small island nation had the 5th largest economy in the world, despite being destroyed in the 1945 World War II. And if Japan made it, the world what it was the thing. All of this actually was putting a lot of pressure on the US economy. There, the companies were finding it very difficult to survive. If you actually look at the dollar value, the dollar, the DXY index is a basket of seven stocks, sorry, seven currencies. One of them is yen. The others at that point of time were different, but now it is Swiss franc, euro, and the others. But at that time, we had a different basket itself. At that time, if you look at how the dollar index moved, the dollar lost value. So any up move in the currency is that you are losing value. So basically, the dollar lost value went from 90 to 160, which is in the 5 years it lost kind of 80% of purchasing power parity, like the purchasing power rather of the dollar was lost in 4 years, 5 years time period. All of this was kind of something that the US government was not being able to sustain. Japan was so dominant at that point of time. There was a particular movie which came out to be called The Blade Runner. It showed Japan dominating the entire world in a way, and that was how good Japan was back in 1980s. All of this led to a particular accord, a Plaza Accord, being signed in 1985. This was between the allies, the one that made the dollar index. It was Japan, West Germany, France, US. All of them signed a Plaza Accord, which said that the exports, there was obviously a lot of surplus in Japan because they were making so much and the world was buying so much. But this Plaza Accord, eventually what it did was it made US goods more attractive than Japanese goods. And what we saw was basically from 1984, yen losing a lot of kind of strengthening so much. So it strengthened from 250 to 150, that the Japanese exports became unattractive in the world. They lost a lot of value. So, however, with this, because this accord was signed in 1985 and the Japanese government thought that it would affect the economy, what they went and put ahead was basically before the agreement, their rate were around like before the agreement, their rates were a little higher. They were around 5% odd. They brought it down to 2.5%. They made their credit markets very liberal. So there was no credit check. They were throwing out loans to everyone. They realized that Japan would possibly slow down because of the accord, and there was absolutely a liberal policy as such. Not a lot of not a lot of credit checks were put into place. Loans were given out left, right, center, and all of that led to the stock market and the real estate market speculation. The tax policies were also very lenient, and that is why in the second half of 1985 you see this massive bull run in the Japanese equities, because money was very fairly freely available. There was a lot of speculation, and at the end of this particular, over here at least, the Japanese market looked like a kind of a bubble in that. So once they realized that this is unsustainable, they had to take drastic steps to cut down these free flow of money. A number of different policy mistakes that they ended up doing. There was a banking crisis. There was zombie banks, and some banks had to be bailed out. There were fiscal policy missteps. There were monetary policy missteps. Capitalism was quite crony at that point of time, and the workforce was shrunken down because there was actually no wage growth as such. Some of the major policy mistakes that they ended up doing was basically they did not write off their NPAs just to combat that particular fall that had started. They also failed to properly restructure the banking sector, and eventually some bit of good measures they did. But all of that actually led to an entire, possibly a 20-year hiatus in, like, from 1990 to 2020. That's a 30-year of long, depressive state in Japan. That led to very sluggish growth, a deflationary kind of an environment, and a population, because immigration was very controlled. The workforce was being shrunken down. The population has aged up. So all of that kind of led to a very depressive state in Japan. Now, moving to the next chapter, and where the land of the rising sun, having gone through the morning, the noon, the evening, and the night, it's trying to rebuild back again. So this is where after 2020, I think Japan was one of the first to report that we had a COVID case. From there on, the Japanese markets have been on a tear. They've been on a tear, because in 2016 they had started this yield curve control, which kept the interest rates at a very low base. That was also not kind of percolating into GDP growth. However, because there was no wage growth as such, but now a lot of things are changing, and that is where in the very first, when we were discussing the global macro scenario, that is where we said that Japan looks one of the better developed markets out there. Um, and so this is what has happened. The bubble high of the 1980s, the end of 1989, the bubble, we've been able to take that out. Now all of that is just market, but why does Japan hold a major position right now? Because Japan is one of the biggest total, like this, these are US imports by countries. They're one of the countries which has more than $100 billion of imports, like US imports more than $100 billion from Japan. It still continues to buy a lot from Japan. It's one of the one of the states that the US continues to buy. Also, it has all the ammunition that it requires. So generally, what happened was, again, well, I said that in 2016 there was a yield curve control that was put into place. The yield curve was basically artificially kept at zero. This is this long period of artificial zero rate cuts that they let go last year. They've started increasing interest rates because inflation was, frankly, they were one of the first, like, to realize that even without GDP growth, they realized that inflation could be a very difficult thing to manage. So what they did was, they, instead of this is when US started cutting rates. This is when the rest of the world started cutting rates. They started increasing their rates. Now this is a very weird correlation that happens, because generally the interest rates in Japan are low compared to across the world. A lot of free money is available from Japan, which then, so you can buy at very low. This is basically called the yen carry trade. So you can buy at very low rates and then invest into countries where the rates are much higher. So the differential basically eventually gives you the return. This is a very funny correlation here, that whenever the interest rates in Japan start going up, you followed by a recession. Whenever interest rates start going up, your recession kind of ends up following. So they started increasing the interest rates. Generally, what we've discovered in our research is that it takes at least 15 to 18 months post the rate hike in Japan that the recession kind of follows. Apart from that, Japan actually is one of the largest bondholders of US treasuries outside of US. It is not one of the largest, it is the largest bondholder out there. And that is when having somebody else bond feels very powerful. That is why Japan gets a better tariff deal. One, it is US imports quite a bit, a very large portion in Japanese goods, and they are a very large holder of US debt. So that's a fair, like, yeah, I'll be blunt here. That's a very good ammunition to have when you know that your bondholder is finding it difficult to service their debts. So that is why Japan matters. That is why we started looking at Japan. We started looking at Japan back in 2023. We continue to look at, given that you saw this extreme rise in the Japanese market just post-COVID. We were a little skeptical around valuations. We would love to see it a little much better on valuations to kind of go back in again. And also Japan has been previously has been an ally of US. So this time around, we don't know where the government would want to lay their bets on. It would. We feel that, at least I feel that Japan is the one that could at least end up deciding whether you have emerging markets versus the developed markets, or you have an east versus west kind of a scenario out there. So they hold a lot of cards, at least in their ammunition, and that's a good place to be. Having completed the section for this, I'll just quickly go through the questions that everyone presented, at least in the forms that we gave out. After that, I'll just open the floor for questions. One of the questions that we actually got was basically that US is so India is very bullish on renewable energy, while US has not been the political pressure, at least in US, has not been towards renewable energy. And what do we think? Uh, uh, we continue to be remain bullish on oil, at least from a medium term perspective. Given that we still not made that transition, and we see that supply kind of the demand outstrips the supply. This is a projection by Reichstand Energy, which tells us that the existing producing wells are losing have started losing their capacities there, and the new wells that are in discovery and the new wells that will start producing, they won't be able to meet the mean demand out there. So it will be kind of a gradual slowdown in the uses of oil. And this is what on the right hand side, this is something that we kind of keep discussing every time around, that how does energy transition dynamics take place in a world that is very high on geopolitical tensions and has a low renewable adoption. We think that there has to be a price driven shift. This is similar to what happened in 1960s and the 70s, when oil was trying to replace coal as a particular as the main source of energy. So oil just did not replace coal by being more efficient. It replaced coal by making coal much more expensive. So a similar story could play out as we move away from oil to green energy. You in a world which is very high on geopolitical tensions, and the adoption is low. Why do I say adoption is low? Because we still haven't moved towards EV. We don't even if you go out on the road, we see fairly a large number of petrol cars. Even if you were to buy a car right now, we would open up a spreadsheet and kind of calculate how much does a petrol car cost and how much does an EV cost, and what is the cost benefit analysis that we end up doing. So here there is a particular assumption that we end up making, is that oil remains at 100 rupees a liter, and that's an assumption that we go with, and hence that cost benefit analysis still points towards, most of the times it still points towards buying a petrol or a diesel car out there, so a car running on gas. We also don't see a lot of move away from the normal electricity to a solar one. So if that has to happen, if that transition has to happen, that transition has to happen through a price driven shift. Basically, ideals don't change your habits. It is actually the when it hurts when you go to the petrol pump and a liter of petrol starts costing a far more, and every time that you start thinking that I should rather move to a EV car, that is when actually the transition takes place. So we believe that possibly this would be the swan song is that last act of a particular band out there. So possibly we think that oil should become much more expensive to make renewable energies be the first choice out there. So that's how we kind of position ourselves going forward. We continue to remain bullish as from a long-term perspective, from a mega trend perspective. We continue to remain positive about green energy, but only with proper valuation. However, in the medium term, we continue to remain bullish on oil because that transition, the oil has to be very expensive. Um, we were asked a question about earnings, given that the first quarter of earnings were out, the June results have come out, and a lot of us felt that earnings were slightly bit muted around for a lot of companies. Our analysis show that overall, so what we kind of ended up doing was basically take the data for the large cap, mid cap, and small cap. Here we made an exception that we've only taken companies greater than 500 crore, because below that there is quite a lot of noise. A number of companies don't, like most of the companies don't hold a con call, and there is quite a lot that can go around. So we've made that baseline case of looking at companies greater than 500 crores. How we do this is basically large cap. What we believe is has a market cap of greater than 20,000 crores. Mid cap is basically between 5,000 to 20,000 crores, and a small cap is between 500 to 5,000 crores. So the total number of companies in large cap are came out to be 347. For mid cap, it came out to be 416, and nearly 1,000 companies for the small cap. A total of 1762 companies passed this filter of greater than 500 crores. When we actually want to compare, we compare like how were the sales when we compare this quarter with the last year quarter. So when we're comparing year on year quarterly sales growth. So the number of companies that have a positive quarterly sales growth turns out to be a total of 76% have a higher sales this year than it was last year, and 63% of the companies have a higher profit than it was last year. If we were to look at companies which have higher sales and higher profit, then it comes out that 55% of the companies have a higher sales and a higher profit than when compared to last year. If you were to compare quarter on quarter, because I don't know why markets love comparing quarter on quarter, they're trying to strip out a lot of seasonality away from the from how earnings move, but they love it, so we did it. So basically, quarter on quarter sales positive were basically for 47% of the companies, and quarter on quarter profits were basically 49%. So this is where we started investigating a little more, because generally sales would drive profits. Here the number of the companies having higher profits got us much more interested. So when we actually drove into this, we saw that this mismatch is coming because of happenings in small caps. When we drilled down more, we actually realized that small caps are kind of giving out a lot of other income without proper footnotes. So again, something to be aware about. Now, when you actually look at which companies have done better quarter on quarter basis, both in sales and profit, 33% of the companies have done better. And overall, if you want to check that whether you've been done better on sales, profits compared to last year quarter, and if you're better off with the last quarter as well, then 22% of the companies have done better in that field. So I wouldn't say this is muted. I think it's fairly average as such. This is how the numbers look like every like almost every quarter. Large caps obviously are driving much more better results than the other ones. We went a step ahead and sorted out which are the better results that have come out. It shows that public banks, fertilizers, cables, and dyes and pigments were the companies that gave out better results. The ones with the worst results were basically plywoods, footwears, paints, and leisure services. These are the sectors that gave out poor results when we compared them across the last year's quarter. So the major learning from this is that it's been quite an average earnings season. 22% is not a bad number. It's not, I wouldn't say it's a very poor number. It's fairly good when you are actually filtering out a lot of things. On the top, if you were just looking at sales when you compare it to last year, almost all the large caps gave a better result. Almost 3/4 of the mid caps gave a better result, and almost 70% small caps gave a better result. So doesn't look muted, at least in those terms. It's just that the markets have been choppy, so those haven't gone through. And one thing that we really want a lot of people to focus on is this particular issue that we have when comparing quarter on quarter and the other incomes. So do look out for companies that are doing this, and take an informed decision on them. We got a number of questions on tariffs. Yes, it's a reality. We are the country with the largest tariff in the rest of Asia, and our peers have negotiated much more partial reliefs. But our macro, that we've got a lot of cushion there. We've got almost $700 billion of FX reserves. Our FDIs are fairly strong. So what we feel is that the growth premium for India is real, but the tariff premium will kind of test it. Overall, the question today remains: one that we all have to answer is whether are if we are producing, if we are self-reliant in production, are we self-reliant in consumption as well? Can we consume Indian products, and can we actually truly become the Atmanirbhar India that we have the vision of? That the consumption has to play out, and if we can, we feel that a country with a very large population generally deserves that kind of a growth premium as such. If you were to read a lot of news, a lot of experts feel that these kind of tariffs will dent around 1% to our GDP numbers. Those are speculations as such. We yet to see what happens there. But even at 1% discount, India would still be growing at around 6.8%, which is fairly a large number than the rest of the world, which makes us still the largest growing economy in the world. In terms of sectors, the ones those are actually highly impacted are capital goods, textiles, gems, and jewelry. This is what we covered last time around as well. And autos are obviously the ones that are largely kind of done. But what we realize is, at least in textile and gems and jewelry, we are a large portion of the US imports. Like for an example, 13% of US imports on gems and jewelries comes from India. It will find it fairly difficult to replace this entire 13%. So the numbers, the sectors with a smaller number here would find it easier to be replaced by competitive countries, and that is where gems and jewelries and textiles and export-oriented autos are the ones where we feel that kind of could face some bit of things. Some bit of things which make a very positive impact because of tariffs are that India has to start looking inwards. So we're looking at Indian oil and gas drillers, and as we try to move inwards, we would want to see a lot of actions taking place, at least the ones. Why don't we think there is a high impact on capital goods, and why don't we think there is a high impact on chemicals or others? Because we feel that India at this stage can be self-reliant. A lot of capital goods, a lot of infra can be used in India itself. A lot of chemicals can be used in India if the consumption comes through. The consumption data is something that will drive what returns come through, and that would actually prove whether we are totally self-reliant or not. So we got a question as to what we feel Indian markets would do for the next quarter. Again, short term is something that we generally don't think one should look equities into, because we had a question. This is and because it is a quarterly question, it cannot be looked from fundamental lens. It has to be looked from a technical lens. Technically, this is what we're kind of looking at. We see a small demand zone somewhere around so this was made over the weekends. So the market had closed at 24,425 on Friday evening. That is where we think a small bit of demand zone remains. There is a large demand zone around 23,800 to 23,250. This is where I said that the risk over here is basically 3 to 4%, and this is the risk we are willing to take and then there is a very strong demand here in terms of near 22,000. This is the low that India made around the tariff, the 2nd of April, like 3rd of April, or whenever we opened up after the tariff. This is where and there have been multiple places where demand has been bought into the and has been able to sustain the markets in a way. And on the upside, we feel that obviously there's a fairly large supply zone here, and it will this needs to be actually crossed to for India to see a new all-time high. So again, 3 to 4% risk to reward ratio seemed quite interesting for us to be able to deploy quite a bit of cash. We don't want to. We would rather let go of a number of we would rather we don't want to let go of the remainder of the upside just for this 3-4%, and hence the reason for moving up to a slightly overweight in India. We got a lot of questions on volatility, and it was like people some said that this is the kind of volatility that they're not seen across their times. This is a very interesting thing that if there is a picture of success um, across a large period of time, it is this. This is the US S&P market. This is from 1953 to 2010. We just started at 2010. A longer period available as well. If you were to look for a long sustenance of a country doing well, it is, we feel that it is the US in the last last 50, 60, 70 years. And this is how S&Ps kind of moved. So if there was a picture of success, then we think that this is and long-term success. We think this is the one that is there. In this period, it just looks very easy, right? So that there's almost like it's absolutely going in a straight line. It was so easy to just buy it here and then just keep holding it. But if you actually look at it, this is the number of times this is the amount of time that the US market spent with a 5% drawdown. What is a drawdown? Drawdown is basically how much you are fallen off from the high, from the all-time high, how much down you are. So this is the amount of time that the US market spent with a 5% drawdown. This is the amount of time that they spent with a 10% drawdown. And this is the amount of time that they spent with a 20% of drawdown. So when you actually look at it from a very long-term perspective, it does look like a straight line, but more than the time that the gaps are there, it spent a time in a drawdown which was larger than 5%. So that's the thing, that volatility is your cost to admission into equities. Without a volatile market, returns are fairly not possible. If there was no volatility, there would be no returns out there, and that is where we are. So think of equity from a longer term perspective, and the volatility is actually the reason that returns come through. We are our highs were around 26,200, and we are at least somewhere around 23,500. So we're not even in the 10% zone. Between the 5% to 10% is where we are. So we are in that dark gray zone possibly. So we could be spending time possibly here or somewhere. But nothing to be fairly worried about. We are in a world which is kind of what we always call it and that was what we called it last time around. It was the deja vu, like the VUCA world. This world is supposed to be volatile, where policies change, alliances make and break every other day, where policies change again every other day. You expect the equity markets to be volatile. This is the US example. If we just move to the Indian version of this, and the Indian version, what we find is basically, we've taken the example of Bajaj Finance. Again, disclaimer here, we're not recommending Bajaj Finance. We don't want you to go out and buy Bajaj Finance tomorrow morning. No, there's no recommendation on this. This is just an illustrative perspective. If you look at Bajaj Finance, it is up 87,900% in the last 30 years. If there is a picture of success in India, we feel it is this. It looks fairly good. You could have just bought it here, held throughout, possibly today, just keep holding or whatever that you want to do with it. You would have ended up with an 87,900% return over 30 years. But if you were actually holding it, this is how your returns would have looked like. You would have started out, and for first 10 years, your investments were 80% down, like for a fairly large bit of time. From 2006 to 2010, you were down like 90% on your investments. Across the time, it has had multiple amount of 30% drawdowns, 20% drawdowns. During the COVID, you saw a nearly 60% drawdown in Bajaj Finance stocks, and it continues to give you 87,900% return. This is not an example. This is not one of those ads where I say, आपने अगर ₹1 Bajaj Finance में 1995 में दिए होते तो आज आपके पास ₹880 होते, whatever that is. This is not that. This here I want you to allude to the fact that how many people actually bought Bajaj Finance in 1995 and are continuing to holding it. So looking at equity from a longer term perspective, the volatility comes out of the picture and eventually gives you the kind of returns that that particular. So buying into good quality, durable companies is what we feel that could give you much better returns over a longer term perspective. Finally, again, we ask our portfolio returns every single time. Here is the portfolio returns. The green band that you see, we run live portfolios for the last 29 months. The green band is basically, again, this is something that where we don't, we think each market cycle is different, each client is different, but this is the range that we kind of give out. and yeah, the orange line is basically the gold, movement. Blue line is the equity movement, and that green band is our portfolios. Um, yeah, I think we just gone 10 minutes over time, but I'm happy to take questions if you've got any. And yeah, sure. I'll stop.